The government shutdown still has us in the dark on a lot of key economic data, but some of the nation's biggest banks say the U.S. economy remains generally resilient. That's their word. That is a very different view from what most Americans think. It's from what they're feeling. More than half of us believe the economy is getting worse. So we have to ask the question, what are they seeing that we are not? And joining us now, CNBC senior analyst and commentator Ron Insana. Is it just that the economy is getting really great if you own a bank?
Well, it's certainly part of it, Katie. I mean, when you look at trading revenues, merger and acquisition fees that are going to the nation's largest banks, they helped Morgan Stanley and Goldman Sachs and Bank of America advance rather smartly, beat their earnings and revenue estimates for this quarter. But there is some resilience among consumers. Now, Mark Zandi of Moody's Investor Service recently noted, that 49.2% of all consumer spending is being done by the top 10% of all wage earners in the United States. And as you go down the income ladder, folks are either keeping up with inflation or falling behind. So it is very much a mixed picture, or as Heather Long, formerly of the Washington Post, now Navy Federal Credit Union, describes it and resurrected this notion. It's a K-shaped economy. It's going up at the top and going down at the bottom.
So, I mean, when they say it's resilient, it's resilient for some, not resilient for all.
Correct. Correct.
Yeah, and that's not great.
No, not at all. And you know, we've seen this a couple times in past economic history where, you know, the top is doing better than the bottom and income inequality is widening and so on and so forth. We're also seeing, you know, massive investments in AI infrastructure, which is propping up a certain sector of the economy and providing more jobs where other areas are losing them. And so it's very much a mixed picture. But, you know, banks under certain circumstances can weather these storms. We are seeing higher credit card delinquencies, auto loan delinquencies, a little bit on the mortgage side. So where you stand is where you sit when it comes to the economy.
Oh, let me put up on the screen some more economic indicators that are normally warning signs. These are recession indicators via the Washington Post. Cardboard box production down 5% in 2025. Hamburger helper sales up 14.5%. Truck sales down nearly 15%. Thrift store visits up 39%. Although thrift stores are very popular right now among the fashion crowd, so I'll put that caveat in there.
They are, but you're also seeing some, you know, supermarkets like Aldi and Costco pick up folks who are effectively trading down, if you will, and even those with money are going to places that are less expensive to make their dollars go farther. The hamburger helper one is the one that caught my eye a couple of days ago, because being a child of the 60s and the 70s, hamburger helper was introduced during the great inflation of that period, to make your grocery dollars stretch farther. So you would buy ground beef and then you would add the macaroni in the box and the sauce, and that would make a larger meal out of a smaller amount of food. And that was a way to stretch grocery dollars. Groceries are still more expensive today than they were a year ago. So as I said before, it's very much mixed, and there are people who are looking to extend their dollars as best they can. Cardboard boxes, the things that we get shipped to us from Amazon or any other company that is sending us goods via truck or via drone in some instances. Cardboard is a very big economic indicator and always has been. And linerboard or container board volumes, as you showed, are down. And that's been an extremely reliable indicator of the economy softening.
Well, there you go, down 5%. Also not going to help things in terms of the money people have in their pockets. A failed 9th vote in the Senate on the government shutdown, so it will continue. Ron Insana, always good to have you.